Donald Trump's stunning victory on November 5th has reverberated through the financial markets by sending stocks to all-time high, treasury yields higher, spreads tighter, and strengthening the US dollar. Looking ahead, his economic policies could have far-reaching impact on the macroeconomic landscape and financial markets, and that'll only be enhanced by the increasing likelihood of a Republican-controlled Congress. And so what does that mean from a multi-asset lens? Well, first of all, his pro-business policies, such as extending the tax cut from his first term, lowering corporate taxes, and deregulation policies should be supportive of corporate earnings and bottom lines and spur additional M&A activities. So that would serve as a tailwind for risk assets like public equities, credit, and private assets. But that comes at a cost. And that cost, some estimate, could be as much as $10 trillion over the next 10 years. And with a mounting federal deficit and government debt, this could introduce additional sources of volatility and keep rates higher for longer. And in responding to some of his spending policies, Trump has suggested and proposed a number of pretty aggressive tariffs on Chinese goods as well as other non-U.S. goods, which would spur additional inflationary pressures and lead to potentially retaliatory tariffs and dampen overall global economic growth and productivity. Additionally, he has proposed a number of pretty aggressive immigration policies, which would drag down labor force supply and, again, add to that inflationary pressure. And so all of that will be a headwind for risk assets. So it'll be interesting to see the interplay between all of these offsetting factors. And ultimately, the impact will be driven by which policies Trump chooses to prioritize as he takes office. So what does that mean from a multi-asset context? Well, we would advocate for a few things. One, continue to maintain a robust interest rate hedging protocol across the interest rate curve. Two, position higher quality on the credit curve, but be nimble enough to rotate into select opportunities as spreads widen, especially when fundamentals remain solid. Three, lean into private assets, especially private credit, which should benefit from the increasing M&A activities, but at the same time have largely floating rate return profiles that would benefit from a higher for longer rate environment. And then last but not least, from a geographical perspective, we would consider positioning more towards the U.S. domestic market, especially in light of Trump's protectionist policies.